Welcome to the Lady Landlords podcast, where we empower women to gain financial independence through real estate investing. I'm your host, Becky Nova, founder of Lady Landlords. If you're ready to buy, manage, and grow your real estate portfolio, then let's get started.
Do you know the right type of financing for the specific strategy and deal that you are working on to grow your real estate portfolio? If you are not 100% confident in that strategy, today's episode of the Lady Landlords podcast is definitely something you want to take a listen into. Today, we are going to be going through a lot of different types of traditional financing, and also I'm going to walk you through some of the creative financing options that you can use to be able to buy real estate. Now, one of the reasons why I thought this was important to do is I see so many lady landlords get stuck in a position where unfortunately they pick the wrong type of financing, and unfortunately that leads to having them halt and not be able to grow their portfolio. I hear very often from our members in the Lady Landlords Facebook community that it's difficult to be able to scale, that they're not able to move forward. What I mean by that is, for example, they'll save up a ton of money, they're able to get that first property. Great, we have that in the bag, now we're talking about moving forward. But then they get in this position where they feel like they either have to now wait years to be able to save, to put down 20-25% again. And depending especially on the market, what your own savings rate is, that can really take you quite a few years to be able to do and move forward. I know personally, I did not want to wait years to be able just to buy one more property. I wanted to make sure that I was able to retire as soon as I could from my career in cancer research, and being able to understand what type of financing was really right for my strategy and for the specific deal that I was working on really makes a difference. It also can stall people because I feel like when you pick the wrong type of financing, depending on the process and what that looked like, not just from a down payment perspective, but there's other reasons that can absolutely hold you up and now stop you from being able to move forward and get now your next property. So sometimes it's not just a money thing. That's clearly half the battle here. But there are a lot of other ways that unfortunately your finances, your credit, your DTI are impacted by the types of financing that you are picking. And because of that, that can actually also slow down what your speed looks like. All right. So happy to hear. Feel free to share down in the comments what types of financing have you used, or if there's a type of financing that you are hoping to use, let me know down in the comments. I can help direct you and help walk you through what that should look like here. But this is what we're going to talk about today because I find this incredibly important to make sure we understand our financing. When you are moving forward with a property, if you find a deal and you don't have the right financing already in place, possibly even pre-approved, you can end up losing the property, you could lose that deal, and really have to start back at the beginning. Also, I know what it's like still trying to navigate this. 7 years ago, before I bought any properties, I didn't even know that any of these things were options that I'm going to be now talking to you about today. I remember what it was like calling a lender and trying to understand how to get pre-approved, and then having people not give me, and then me not asking the right questions, them not giving me the right answers, or talking about something that was just completely over my head. It made me feel like this was really not the place for me, that I was not in a position to even make it as a real estate investor, and I don't want any of you going out there feeling like that. So with a little bit of education, when we're making those calls, we can feel much more confident in what we are asking for. So to start with, when we think about traditional financing, a lot of the ways that people will get started within real estate investing is simply purchasing an owner-occupied property. This comes up often with a popular term called house hacking. House hacking is actually how I even got started in real estate. House hacking is when you buy a multifamily, you live in one unit and you rent out the other unit. What that's able to do is that has another person that is paying towards that mortgage. This can actually decrease your cost of living. Maybe it covers the entire cost of living for that mortgage, or possibly even allows you to make money every single month by living in a certain place. How cool would that be if you had no rent, no mortgage for you personally, and were able to bring in just a few $100s even on top of that? That really is the power of house hacking. And that was what allowed me to go from paying $2,000 a month in New York City to actually getting paid to live. That increased my savings number, that by decreasing my cost of living, which is how then I was able to roll that into that next property. But owner-occupied financing has some really great benefits in the sense that it allows you to put down less as a down payment, okay? That's also why it's such a popular way to get started. You might have heard of types of loans called an FHA loan or also a owner-occupied conventional loan, okay? These are what are the most traditional loans that you're going to be able to find for people that are going to be doing owner-occupied financing. These allow you to put your down payment at only 3%, okay? There are certain conditions, some of those loans in there, you might be looking at a 5% for a conventional loan. Sometimes with FHA, they do require 3.5%. Also, a few years ago, with the pandemic, things really changed. Pre-pandemic, for an FHA loan, you used to be able to put down that 3%, and that would allow you to still be able to get a single-family, multifamily, up to that quadplex, right? Anything up to 4 units is still considered residential. With that conventional loan, there was that similar option. Due to the pandemic and a lot of people not being able to pay their mortgages, not being able to pay their rents, one of the changes that happened there for conventional loans is that those fees now became a little bit tiered for your down payment. So for example, now you might still be looking at that 5% if you're looking at a single family house on a conventional loan. But if you're looking at a duplex, you might then need to be putting down 10 or 15%. If you're looking at a 3 unit, you're putting down your 15. If you're looking at a 4 unit, you're probably still with a conventional loan putting down your 20, 25%. The same as an investment property. So there's not really that discount to that. But it does still have the option for owner-occupied for you to get an FHA loan, which still, for a fourplex, you can put down that minimal down payment, okay? So those are really some great options that if you don't have a ton in savings and if you are able to live in a property, those are a way to go. One of the biggest misnomers I always hear about an FHA loan is that it's only for, and I'm doing air quotes over here, for first-time homebuyers. That is not the case when it comes to an FHA loan. That just stands for Federal Housing Authority, okay? Even if you own multiple properties, I have 16 going on 17 properties right now, I can still get an FHA loan, okay? It is not just for first-time home buyers. This is something that other people, as long as you are living in the property, that you are able to take advantage of, okay? There are other conditions within that. For example, with an FHA loan, you also cannot have another FHA loan, okay? You can only have one FHA loan at a time. You do have to refinance out of that, but you can use that FHA loan again. For owner-occupied properties, usually you only have to commit to living there for 1 year, okay? I gotta be honest, if I was younger, if I was single, if I was not pregnant right now, I probably would go live in a property for a year, buy a multifamily. After that year, I would move out, move into another multifamily, and continue to do that for a few years, putting down that small down payment, okay? The trick with these types of properties, though, is you have to remember that you have to factor in all of your other numbers, okay? What's great about an owner-occupied property is you will get a little bit of a lower interest rate than you would if it was an investment property, which also helps out, but you also have to consider your mortgage insurance, okay? Mortgage insurance, anytime you're putting down less than 20%, you do have to pay mortgage insurance. That is a small fee every single month that you're going to have to pay on top of that, okay, on top of your mortgage. So do make sure to be factoring that in. There are ways to be able to remove mortgage insurance or PMI, mortgage insurance, or PMI, which is private mortgage insurance. There are ways to get that removed down the line, but you want to make sure that your deal analysis is on point. But those owner-occupied options are a great way to be able just to get into a unit, to be able to get that first property, or once again, if you are looking for your own property, to take advantage of some of those benefits. This is also something you can do with a VA loan if you are a veteran, or also a USDA loan where you are possibly buying a little bit more of an area that is considered rural. You also can be able to put down those lower down payments, okay? In those situations, you might even be able to put down 0%, okay? This is why even before you start buying properties, you can still have that conversation with the lender about what your options are, about what different financing options are available to you and what you could be able to use, okay? So if you're feeling like you're either short on some cash, but you have the availability to move into a property, owner-occupied is a great way to get started and a great way to be able to get one of your rentals just up and off the ground and running. Let's switch a little bit into some creative financing here. So maybe actually before I do that, you might be saying, great, Becky, I can't actually go live in a property. That's not something I can do right now, just not the way my lifestyle is going to work. Cool, totally understand. You still actually can get a conventional loan that is for an owner, you can get a conventional loan that is for an investment property, okay? Which is great. That still gives you an option if you have good credit, if you have the savings, depending on what your DTI is, you're still looking at putting that 20-25% down, but you're going through traditional avenues, okay? So you're still looking at decent interest rates. Decent is a word I'm using very liberally right now with what interest rates look like, but you can still use a conventional loan. It's going to be cheaper than a lot of your creative financing processes, and there's those interest rates. So that conventional loan will still give you that option. So, but you are looking to put down your 20-25%. Right now, I still feel that most of the lenders that I'm speaking to are looking for a 25% down. I feel like we're slowly getting back to a 20% being a normal amount of money that you could put down on an investment property. Pre-pandemic, you used to be able to put down 10%, you used to be able to put down 15%. Those are just really not options that we've had since 2020, but I do feel like we are starting to see quite a few of those still coming back. The only other option that you could do with that is with a lower down payment is to look into a second home or a vacation home, okay? There are requirements for that because it would not be owner occupied in the sense that you're living there full year round as it would be with the first few options that I did give. But in this second space, you can usually put down about 10%, but the caveat there is that you do need to be spending half of your year. That's the usual marker in most mortgages. You do have to be living there. So if you're saying, hey, great, I can get this vacation home and I can rent it out, you do have to be careful because there is a requirement through your mortgage that you would have to be there for a certain period of time. So make sure to have that conversation with your lender. What's great is that there's even an option within traditional financing for rehabs. If you are still planning on living in a property, but it needs some work, or you're looking to get out of something that's so expensive or so competitively marketed, you can look into what's called an FHA 203K loan, okay? So it's a type of FHA loan, but the cost of that rehab actually gets worked into your loan, which is fantastic because you don't have to worry about coming out of pocket with that. There are a lot of different little nuances to a 203K loan, so I'm not going to go into that today because I want to make sure you ladies can get back to your lives here. But we have an entire other episode all about 203K loans here on the Lady Landlords podcast, so go dive into that to learn more about that. So if you are looking to live in the property, want a low interest rate, want a low down payment, and would like your rehab costs covered, a 203K loan might be right for you. But let's switch into our creative financing options. This would be options that if you're saying, hey, I am just not in a position to be able to live in this property, I'm looking for a pure investment property, here are some options that might be right for you. Now, one of the biggest pieces of confusion that I see are between these two different types of loans, which is a hard money loan and a asset-based loan, okay, also known as a DSCR loan, debt service coverage ratio loan, okay? So let's kind of break down what those two are about. The biggest difference in the way that I want you to remember how to keep these separate is if the property needs to be rehabbed, if there's work that needs to be done on that property, which means nobody is living in that property right now, you might want to consider the hard money lender. If the property is turnkey, has tenants already living in it, there's no work to be done, it's rented out, you want to consider that DSCR loan or that asset-based lender, okay? That is the big difference between the two of those. So let's break those down. Asset-based lending is really based on the asset itself, okay? What is the cash flow of the property? So lenders have different ratios that they would work with. For example, a lender might say, oh, well, my ratio is a 1.2 or a 1.5. So you need to ask and get clear on what ratio they work with. But how do they calculate that ratio? Nice simple example here. Let's say you find a property, the mortgage, taxes, insurance are, let's use easy numbers here, ladies, $1,000 a month. Cool. $1,000 a month, and then that property can be rented out for $1,200 a month. You have a 1.2 ratio based on that, okay? Let's say you can rent it out for $1,500. Now you're looking at a 1.5, okay? That ratio is really because the lender is looking at the value and the cash flow on the property and not you specifically. Asset-based lending is fantastic for people that do not have W-2 jobs, okay? Regardless of if you're a full-time investor or you get paid 1099 or you're in transitional space right now, still an asset-based loan could be fantastic as an option for you. They still are going to check your credit. You still are looking at putting about 20% down, okay? There still is a down payment on that. But if you don't have that traditional W-2, an asset-based lender is not looking for you to be the person fully responsible for how that mortgage is being paid, but they're looking for the asset. They're making sure that that cash flow is covering the cost of the property, okay? So that's a great way to get into it, especially once again if you need a little bit more of that creative financing. Let's switch to the other side with that hard money lending. Hard money lending is what you want to look at if you need that rehab cost, okay? Now, hard money lenders are businesses, okay? And I'm going to kind of take that a little bit farther. I do see a lot in the Lady Landlords community that there is confusion between the asset-based lender, a DSCR lender, versus a hard money lender, right? Remember, DSCR lenders are for turnkey, hard money lenders are for rehabs. Then on this side here, hard money lenders and private lenders tend to get confused. So I'm going to talk about private money lending next. Hard money lending is an actual business, okay? That means that they're really not negotiable. They have what their lending terms are. They work with other businesses. What's great about a hard money lender is that they're usually licensed in almost all states. So you don't have to find a hard money lender specifically in the state of Kentucky. You can work with a lender from New York, and it gives you a lot of different options to see who you can work with, what their rates are, okay? Hard money lenders, since they are their own businesses, they are not federally backed like your FHA loans. The hard money lender themselves are the people that can actually state what their requirements are. They set what their interest rates are. They set what experience you need. They also do remember that hard money lenders lend to businesses. They're going to lend to an LLC, not necessarily you specifically. Okay, so this is really primarily used for flips. What's great is that they also will provide the price, they will provide the funds for your rehabs, okay? So you are going to need a down payment. You're looking for a hard money lender, usually around that 20-25%. There is some variability. I've done a couple episodes here on the Lady Landlords podcast breaking down hard money lending because it is fantastic for those that are working on flips, that are doing the BRRRR strategy, and really looking to raise capital through doing work on those projects. But a hard money lender, they can say, hey, you do not have as much experience as we usually require for our projects. We need to see 30-35% down. After you're able to do a couple flips with them, you can get better interest rates, you can get better terms, you can get lower down payments. All of those different things can become negotiable. It's why networking and building those relationships and loyalty within real estate is so, so important, okay? So that's your hard money loans there. They're great because not only will they be able to mortgage that property and cover the cost of that, but once again, they will also give you those funds for that rehab. They do that in what's called a draw period, okay? So make sure if you do talk to a hard money lender, make sure that you can understand how those funds are being paid out and what cash you need to have on hand, not just a down payment, in order to finish that work and get that done. A lot of people, and part of that BRRRR strategy, and like I said, Lady Landlords has another podcast episode all about that, but when you do that, the idea really is to be able, after you finish that project, to refinance it into your conventional loan because, once again, your interest rates are lower, okay? One of the biggest criticisms that you'll hear about hard money lending is how high fees are or interest rates, right? I get it. Interest rates are high. Interest rates have been high for years. They actually used to be worse, much more in the past, and they really ain't that bad now, but I get it. That can make a difference. And anytime you're starting to hear 10, 11, 12%, we're not excited about it. You have to get really strong at your deal analysis, okay? I don't care if I have to pay 12% interest rate if I'm still making the money that I'm hoping to make on a property, okay? That part should not make too much of a difference in the long run, but you have to understand your numbers and you have to think through that entire strategy of what you are being able to do with that property moving forward. What is your exit strategy? Are you renting it? Are you refinancing another hard money loan? Are you flipping it and just selling it? All of those, what is the cost of that? You have to get really, really good at your numbers here. Also, like I said, hard money lenders and private money lenders tend to get a little misconstrued. One of the reasons for that is, to be honest, sometimes hard money lenders will call themselves a private money lender just to kind of use a different term that, to especially a newer investor, is really misleading in my opinion. So a private money lender is really a person you know, okay? That's somebody that you have a personal connection with. So that's a good way to always remember that your private money lender is a personal connection. This could be friends, family, acquaintances, people from networking, people that you know through other people you know. What's great about this is that your terms can be completely negotiable, okay? How much money they are able to lend to you, what interest rate are they looking for, when do they want to be paid back those different terms. All of that is up to a conversation. Getting private money lenders and building out a funnel to use what's called OPM, other people's money, is completely a skill, okay? It is a great opportunity to be able to raise capital, to not have to worry about putting down that 20%, not have to worry about how are you saving, where are you going to have to wait for years to be able to do this, but really creating a win-win situation for you and also that lender. So if you were going to go with the private lending situation, it really is important to have a conversation with that person that you are looking to really act as the bank to fund your projects. It's really important to understand what they are looking for and to come up with agreeable terms and negotiate with something that not only is going to work for you and the deal that you have, but also is going to be able to work for them. Another scenario that is kind of close to that private lender situation, right, which are lenders that you know, everything else, another situation that can be very negotiable is also seller financing. In seller financing, this is usually a person you do not know, but seller financing is identifying a property that the owners want to sell, okay? And instead of going through your traditional banks, seller financing allows you to work directly with the seller and have the seller actually be the bank for you, okay? Here's where now you get to actually determine what that down payment is. You get to determine what that pay period is. Are you paying this person back over 30 years, 15 years, 10 years? What is the interest rate? Those things can all be flexible. We actually did an episode all about seller financing and how to create those terms about a week ago, maybe 2 weeks ago on the Lady Landlords podcast. So if you have not heard that, you can either just write down seller financing down in the comments here, and I'll make sure to send you over that link so you can take a listen to that episode. But we had a fantastic guest that solely focuses on seller financing opportunities, and she talks about how she has built her entire portfolio literally with no money out of pocket. So if you need that episode, let me know down in the comments of the show. I can just write the word seller financing, and I'll make sure to get that over to you. But what's really great about that is it is negotiable, it is flexible in order to have you pick up now new properties without having to come money out of pocket, okay? One thing, and one of the reasons why I wanted to go through this with all of you ladies today is because I hear often, well, I don't have the money, I need to be able to save. Yes, you absolutely need an emergency fund. I don't want anybody out there investing if you do not have those pieces in place, okay? You need to make sure that you're going to be okay. You can cover your family bills, all of those things. But there are so many different options. There's always a solution within real estate investing. It's just deciding which option is going to be best for you. I actually have a financial cheat sheet. If you would like that financial cheat sheet, it breaks down about 13 different types of financing. So if you are trying to sort out what the best way for funding is for you, just write cheat sheet down in the comments, and I will also make sure to send you over that free cheat sheet so that way you can make sure that you are picking the right types of financing for your deals. All right? Thank you very much for joining me today. I hope you enjoyed today's episode of the Lady Landlords podcast. Please do make sure if you are watching me either on YouTube or on Spotify that you make sure to subscribe. Otherwise, if you are watching me on Facebook or in the Facebook group, make sure that you go click on my name, Becky Nova, and hit that follow button there so that way you do not miss another episode of the Lady Landlords podcast. Thank you so much and have a fantastic day.
Thank you for listening to the Lady Landlords podcast. If you're feeling stuck in your real estate investing journey, visit lady-landlords.com to book a 15-minute orientation call with me and see if you're ready to join our mentorship program. Or you can subscribe to our newsletter and join our Facebook group for exclusive real estate investing tips and offers. Invest with confidence. Become a Lady Landlord today.